Good evening, everyone. Welcome to Admiral Markets. My name is Chris. Nennet is, of course, with us as well, and together we take a look at Fibonacci Advanced Part 1. Part 2 will be the same time next week on the 30th of June. We look forward to this topic. Fibonacci, for both of us, a very important tool. We've talked about Fibonacci in the past. That's why this will be focused on advanced concepts. We will not be diving into basics, how the ratios are made, how to apply them to the chart. We refer to previous Fibonacci webinars that you can find on the Admiral Markets YouTube channel for, a more basic, let's say, Fibonacci aspects. This webinar will be recorded indeed. I'm not sure if it will be sent by email, but you're able to find it on the YouTube channel of Admiral Markets, and I can show you that later on how to find that. First of all, before we start with this webinar, be aware that it is shown to a global audience, but may not be suitable for everyone. Take a look at admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity to find out if it is suitable for you and other details. Also, please be aware that trading for exchange and global financial markets is considered high risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. Plus, by continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, from my side, I'm going to dive into some Fib strategies. I'm going to talk about why swing highs and swing lows, why grouping basically price action into good swings is important, and how, if you don't do that correctly, how that could be very disastrous for your Fib trading. I'm going to talk about Fib ratios and Fib targets, how to use them optimally, and also about Fibonacci sequences. So this is a two-part series, so this is going to be divided over today and next week. Nennet has his own material that he's going to present in the second part of this webinar, and of course next week as well. Now regarding the ratios, you can see, of course, basically the 38.2 and the 61.8 fib are the most used, but I have other fib levels as well. Those are basically levels that are derived from those two main levels. All right, so we'll be using and talking about all of these Fibonacci levels. Now the role of Fibonacci is basically to be used as a retracement. It is a significant support or resistance level that is expected to, in many cases, stop price and let it continue within the previous movement. So if you have, for instance, an upside and the downside is retracement, these fib levels, like the 38.2 fib and the 61.8, will be places where price could stop to continue with the previous motion that was up. Now, not all of these will necessarily lead to a trend continuation, but most fibs tend to get respected, and eventually one of these fibs will actually be the bouncing spot for a further trend. So whether it's the 38.2, or if it's the 50 or the 61.8, that's something we never know. But what we do know is that there is significant support or resistance, that price will stop there at the very minimum, and that it could be one of these could be the bouncing spot for a further trend continuation. Now, a very known trader that uses Fibonacci levels is Joe DiNapoli. I hope I pronounced it correctly. And he actually has a book on trading fibs. You could check that out. That's a very good, starting spot or good material for fib trading. And in his book, he mentioned that Fibonacci analysis should be applied in proper context with proper trading and part of a plan. So, how I interpret it is basically that you just don't start fibbing and only using fibs. You have to have a proper context with that. I think that the references to trend and momentum, we have to make sure that trend and momentum are in the charts, can be viewed. We know which direction they are. With proper trading, we mean, of course, sufficient experience. And part of a plan means that we need a trading plan. We need to know how to use those fibs in a coherent trading plan, that we're not just using fibs every time in a different manner. All right, so all of this you have to keep in mind when we talk about Fibonacci is that it's not a standalone tool, but it is a very good part of a coherent trading plan, and it's a very valuable part of that. Last but not least, Joe also added that the loss of opportunity is preferable to a loss of capital. And you're going to see probably when using fibs lots of opportunities. You might see things that happened in the past and regret that. So don't get too tied down, don't get too annoyed by that. There'll be plenty of opportunities. Sometimes things seem more clear in retrospect with the fibs. So don't get too annoyed by that. There'll be plenty of opportunities in the future. All right, with that said, let's take a look at DiNapoli Fib Method. And this is the first strategy I wanted to talk about basically in this webinar. Now, DiNapoli said that you can use fibs with waves, but you don't have to. And in fact, he did not tie fibs and waves together. If you do have knowledge of Elliott wave analysis, then using fibs will become or turn probably be more natural for you, will be easier to implement. If you don't have any experience with waves, then you can still use fibs. All right, that's what he was explaining in his book. Now, his method has nothing to do or is not connected to waves. I will, however, talk about waves and fibs and how they naturally fit, and they're a very good, connection. They're a very good supportive tool to each other. But that will be later on this webinar or next week. All right. But the DiNapoli method does not necessarily need waves. The DiNapoli method was specifically looking at a fib confluence of 38.2 and 61.8 fib. So in his method, he was not looking at other fibs like the 23.6, the 50, the 78, or the 88.6 fib. DiNapoli was referring to market swing highs as significant lows or highs, and he acknowledges that this is very difficult to identify, if you're just maybe starting out. But as you get more market experience, you will be able to recognize those swing highs and swing lows, those significant highs and lows, as he called it, easier. He was referring to a discretionary eye when calling that. So he did refer later on, in this book, to the fact that momentum should have 8 to 10 candles at the very minimum, preferably 15 candles. All right, but otherwise, there's not a clear definition for significant. But I don't think it's that important because when using his fib method, basically he was using multiple tops and bottoms, and he was looking for confluences at the 38.2 and the 61.8 fibs. So what he did basically was, first of all, establish the trend. He was using oscillators, the MACD, for instance, for that, together with his stochastic. All right, now I have added moving averages myself to this story, so you can see that it's a clear downtrend in this case. But once again, DiNapoli was actually using stochastics and MACD. MACD for trend, stochastics for momentum. So if the MACD was bearish, that's a downtrend. And in this case, you can see the Awesome oscillator, very similar to the MACD, is in a bearish mode because most of the bars are below the zero line. So first of all, you need to know what the trend is. First of all, you need to know if there is a trend. And secondly, if there is a trend, to what direction. In this case, it's down. So what he then did was basically, if we were at this point in the chart, all right, he would be looking to fib down to this bottom. That would be the bottom he would be using, but he would be using different tops. He would be using a significant high close by and a significant high further away. So he would be using multiple significant highs, any high that basically is relevant, significant, and on the chart when looking at this time frame. In this case, we have two significant highs. So he would put a fib from this high to the current low, and from this high to the current low. So the low would be the same in both cases, but the high would be different. He would then be looking at the 38.2 and the 61.8 of both fibs. Now, you will see more fibs on my chart because I use more fibs than those two. But in his method, he would be looking for a confluence between those two fibs. So the bigger fib has a 38.2 fib right here. The smaller fib has a 61.8 fib right there. Let me use a different color right here. And let me put red for here. That's the smaller fib. Blue for here. That's the bigger fib. So there was a confluence between the 38 and the 61.8 fib of the small and the bigger fib. And that's the level where you want to basically pay more attention. That's the level where there's more confluence. Confluence is important because, as we all know, in fact, fibs work great, but if we have more fibs at the same spot, they just provide even more importance. If we have basically any fib, will play an important role in the sense that it will be respected and there's a chance that price could use it as a bouncing spot. But if we have confluence, more confluence, 2, 3, 4 fibs at one spot, then that level becomes even stronger. And hence, we should pay even more attention to it than other levels. This is indeed a 1-hour chart. DiNapoli was often referring to Forex, but also other commodities, other financial instruments like commodities. He was referring to daily, weekly, monthly time frames, but also sometimes intraday. And this is intraday or intra-week with a 1-hour chart. That's fine. So the market indeed roughly stopped at this spot for a downtrend continuation. Now, I gave you an example with 2, but it doesn't have to be necessarily 2. It could be 3. Actually, if I remember correctly, DiNapoli was looking at up to 4 or 5 potential swing highs, swing lows. So in an uptrend, right, we would use support, multiple support levels, but the same top. All right, in a downtrend, like the previous example, we would use the same bottom. All right, so it's always the same top or same bottom, but different support or resistance levels depending on the up or downtrend. So in this uptrend, all right, we'll be using basically this bottom to this top, then this bottom to the same top, and then this bottom to the same top. And we see definitely, of course, a lot of confluence, for instance, between the large 38.2 fib and the smaller 61.8 right there as an example. We see confluence between, let's see, here's a 61.8 and a 50, not the 38.2 fib, but there's another potential confluence where price stopped right there. All right, so it will depend, of course, from situation to situation, because each swing is different, each fib is a bit different, and hence the ratios will have different relationships. All right. But in this case, in this particular scenario, you can see confluence, for instance, between the 38 here and the 61.8 here. And we got a follow through with that. All right. This is another example of the Eurodollar 4-hour chart. And maybe this screenshot is a bit better. The resolution is not low. It's just that the chart has been squeezed probably a bit too much for your view. So here you can see another example of the Eurodollar 4-hour chart, and you can see that in this case, price broke this high, right? So if we would be looking here at this spot for the swing highs, swing lows that we would use according to the DiNapoli method, we would use the significant high. We could use this significant high, maybe even this one and this one, for instance. All right, and we would see confluences here and maybe somewhere around here, and those would be levels we want to keep an eye on. But as soon as the first 61.8 fib gets broken, here, this is the 61.8 of the first swing high, swing low. All right, in that case, when price breaks through that level here, it's already a first warning sign that this swing high, swing low is going to be broken, as it did here. And it breaks basically when it breaks the top, of course, but when breaking through the 61.8, it's already a first warning sign. And in that case, there's already a chance that price might make a bigger retracement and might make a retracement against a larger part of that swing high, swing low, not only this very last piece. All right. That's why looking at momentum is so important, and I'll talk about that later. Trend and momentum are very important to keep an eye on that so that we're not fibbing against strong momentum against the opposite direction. So, how about entries and stop losses? Basically, you would be looking at using the confluence for entries and using a stop loss, according to DiNapoli, that is below another significant fib. So if we have confluence between 38 and 61.8, we could be, for example, placing the fib below the 61.8 fib here of the bigger fib, or the 50 fib here, for instance, and the 78.6 fib. That's where we could put the stop loss, right there, below the next significant fib. Now for TPs, he was using a different mathematical formula, but I just keep using my Fibonacci ratios. I think that those work fine, and they're a lot easier to put on your chart. You don't have to manually calculate it. My targets are done automatically, and we'll show you those minus levels in a second. As you can see, the target's nicely being hit. But for the entries, you're looking to enter basically at the confluence with a stop loss below the next fib level. Now the entry I would add myself could be done in multiple ways. One could be a pending order. One could be waiting for, if you're able to monitor the charts, to wait for candlestick reaction to that fib confluence, for instance, as a different way of entering besides a pending order. And yes, this is recorded, by the way, Ilya, indeed. And we could take a look at live charts if we have time. Hopefully, we'll manage to get there. So that is how DiNapoli used it, basically, looking for fib confluences with using multiple tops in a downtrend and bottoms in an uptrend. Now, important is that there is a trend and that there is no range. Also important is that momentum is on our side. But if the momentum is not on our side, it is actually more important than trend. All right? We could have a very clear downtrend here, but here we see momentum going quite strongly against us. That, in fact, is a very important and significant clue that price might make a counter trend retracement or reversal. So if you see momentum going against the trend, be very leery of that and be very careful of that. And I'll show you how we can use that actually for taking counter trend trades and with the trend trades in just a second. But always remember, never neglect momentum. It is more important than trend. Momentum typically has 8 to 10 bars. 15 is better, according to DiNapoli. I myself already basically keep an eye on momentum if I see 3 strong bars going in the opposite direction of the trend. All right, so if the trend is down, but I see 3 strong bars going into the opposite direction, or actually 2 already, I'm already cautious. I know that the retracement could occur, and if I see a third within 6 candles, then that's already a first indication that a bigger momentum could occur. And the bigger momentum is confirmed basically when we have 8 to 10 bars in that direction, in the new direction. 15 is even like a double confirmation. Alrighty. So you probably know that trend is important and momentum is important for using fibs, because if price is in a range like this and you start fibbing it from here to here and here to here and here to here, your stop loss is going to get hit often because price is not respecting these tops and bottoms. It's basically making some kind of pattern, and fibs are not good in those particular zones when using fibs in this particular area. They are good in trends and momentum, but you probably already know that. All right. So if you have already looked at more basic areas. All right. So that basically wraps up the first strategy, the DiNapoli multiple fib retracements, basically using the same top but different bottoms and looking for that confluence, looking for confluence to enter and putting stop losses below the previous bigger fib. However, if the first, let's say the first fib, the 61.8 gets broken, you want to be a bit more careful regarding potential trend reversals. These two fibs could still be okay, but you want to be, in that case, a bit more careful if a bigger retracement could occur. All right. Strategy number 2 and 3 is something I want to talk about in just a second, because with DiNapoli, the swings, swing highs, swing lows, basically are using significant tops and bottoms. But I think it's important to talk about what is significant and how do you define a swing high, swing low, because that's very important for fibs. When we do that, once we finish that, then we'll be talking about how we can use these two strategies that are also using those swings. All right, so that's why I want to first talk about swings, and then we'll talk about these two strategies. The strategy basically is using the fib on one with the trend and one counter trend to look for targets to trade with the trend. All right, and the third strategy is basically not using multiple fibs but only one fib, and only using the fib, only changing the fib once you've hit the target. All right, so there are different ways, as you can see here, to fib. The third one is basically fibbing from retracement to target and only using one. Here we're using two fibs, one with the trend, one counter trend to gain confluence. And with DiNapoli, we're using basically anywhere, from 1 to, I guess, 5 fibs, but in the same direction. All right. So I want to quickly talk about swings. I think we've talked about swing highs, swing lows, and defining swings already in previous webinars. But very quickly, some tips to improve are swing recognition. And of course, defining the trend and momentum is important in itself. We've had webinars on that separately, so this is not the place to talk about that. It's better to refer to those webinars to understand how you can measure and how you can see if there's a trend. This is not the place for that. But it is an important feature of good fib trading. So some tips about how you can define better swings. Some traders like to look at line charts because you can see bottoms and tops a bit easier, perhaps less cluttering. So for instance, here, from here to here, you can clearly see how price is using those tops and bottoms as part of a swing high, swing low. So it's, for some, perhaps a bit easier. Fractals, for me, definitely make it easier. I don't like the line chart that much myself, but I wanted to show that possibility for you to use it. Fractals are great because they show significant tops and bottoms. 2 candles to the left, 2 candles to the right. So that helps always. Moving averages are a good guideline. For instance, you can see here we're in an uptrend. That helps with trends, but it also helps when price, for instance, retraces back to the short-term moving average, or if it retraces back to the long-term. That gives you a bit better idea once it breaks through the short-term moving average here, that we're not only retracing this piece, but when we break through the short-term moving average, we could be retracing the entire piece. All right, so that's how moving averages can help with identifying which swing are we retracing at this point. So that's how moving averages can help. Fractals indicate, certain candle highs and lows are not that important. The fractals, candles that don't have a fractal tend to be less important. All right. Oscillators help because basically when the oscillator crosses the zero line, anything in between those crosses is a, when it crosses from one side to another, is one piece. So for instance, this is one swing high, swing low, because you can see that the price action between those two blue lines, all right, is indicated by those arrows. So what is the most natural swing high, swing low within that piece to the downside, because the oscillator was moving below the zero line? And that's where we have the green circles. So you know that the swing high, swing low is over when when the oscillator gets back to the zero line. And in that case, you know that this was the swing high, swing low, and you can put the fib on that swing high, swing low. I also use time factor, 5 to 6 candles, not breaking a high. You can see one push of momentum. 5 to 6 candles, not breaking that high right here, where I have the blue arrow, also indicating the end of a swing high. Waves is a separate topic. I referred to wave webinars that we had in the past. And you can wait for the fib target to get hit. But I'm not going to talk about that because that's a separate strategy that will be discussed as well. Some more examples. So basically, when you had here, for instance, a push lower, here, a push lower, then you can see as soon as price is basically making lower highs and lower lows here, you can start fibbing it into the direction because we already had basically a downtrend here. So we're looking for a continuation on the 4-hour chart. And if we zoom in on the hourly chart, you can see that we already had lower lows and lower highs. So if you start fibbing it from here to here and look for a fib like the 38.2 fib, you got a turnaround right there and a follow through to the downside. Next fib from here to here, you got to respect the 61.8 fib. Now eventually you don't want to keep fibbing in that same direction on the hourly chart because eventually this oscillator will turn back up. All right, so what I mean with this, to simplify it for you, is that if you see a trend on the 4-hour chart, right, you can zoom into 1 time for lower and look for swing highs, swing lows within that trend or momentum on the higher time frame. But you don't want to do that too often because eventually on the hourly chart, it will not continue forever and you will get a bigger retracement. So you don't want to keep fibbing on the hourly because there will be a bigger retracement eventually occurring. So you can do that a couple of times, but not too often. So as the 4-hour chart keeps showing momentum, you can keep kind of fibbing on the hourly chart on these swing highs, swing lows. All right. As soon as, for instance, here you can see the 4-hour chart losing its momentum, when the oscillator turns from red to green, that would be the moment that you don't want to fib on the hourly chart anymore. Then you want to keep on this 4-hour chart and wait for this retracement to happen because it's now retracing on the 4-hour chart. So you have various swing highs, swing lows on all time frames. The 4-hour time frame, for instance, is showing one swing high, swing low push. And on the hourly, you would have multiple, basically that one push on the 4-hour, you can split in multiple segments on the hourly, as you can see. And there's nothing wrong about fibbing those separate parts, those separate swings for a while. All right, but eventually the oscillator, you get divergence, for instance, and then you want to be careful with fibbing into that direction. All right. So I got 1 minute left, so that's not too much. I think that we're going to be talking about this material probably next week. What I do want to, because this will be rushing too much, what I do want to tell you is, let me see what I can share with you now, is the targets. I can tell you basically the main targets I use are the -272 target, and you can change that, you can edit that in your fib retracement tool. So not only would you have the fib retracements, but also the targets you would fib from in the downtrend from high to low, you would have the retracements here and the targets below. And that's cool because you have all the things in one tool. I use the minus 272, the minus 61.8, and the minus 100. And other targets, by the way. But I don't know how many targets you want. These three, on average, should be enough. But I myself have minus 161.8, minus 200, minus 2618, and even the minus 423.6 for very, very far extensions. All right. These targets are very valuable for take profits and for potential entries, as we're going to see next week. For now, we'll leave it at targets because we already talked about basically to wrap it up. We talked about DiNapoli, how to enter, how to play stop loss, and these are the targets I use. DiNapoli actually uses different ones. I would refer to his book if you were interested about that. But this is easier for me because I use these levels. It's automatically calculated by the retracement tool, so it's easy. All right. Regarding how you can find the recording, that is easy. You just go to youtube.com. What you then could do is just search for Admiral Markets as a first thing, but you can also just use this link right here, and I'll just send that to you, or you could stop the recording if you're looking on later on, and you can type that. And basically, you'll see the recordings uploaded here. There are also playlists, so if you're curious, if you're looking way later in the future, you can go to playlists and then go to Pro Learning Lab webinars, and you will find it, here in this category. The 23rd of June, 2016, you'll find that here, or you can even search for it. There's some, here you go, magnifying glass. And you can click Fibonacci, all right, and you'll find it as well. What oscillators am I using? In this case, I'm using the MACD. The Awesome oscillator, but you can use the MACD too. Roughly the same. For trend, you can use an oscillator. Stochastics for instance, momentum. I use others. DiNapoli was referring to stochastics. I use others for that. You can look at the live webinars on Tuesday, Wednesday to see which ones I use for that. All right. So next week, we're going to dive into a lot of material regarding two different strategies and also how to use fibs and waves, fib sequences. So there's going to be a lot of material there. But for the moment, I'm going to pass it over to Nenad. All right, there we go. Hi, Nenad. How are you doing?
Hi, Chris. Excellent. I'm preparing for tonight's event on Remain or Brexit, so I was a bit busy, but I was following you, and definitely very good presentation. And I will not have a lot more to add and to actually show important tips for all Fibonacci traders and some tricks how you can actually do it without stress. So how you can maybe incorporate this trick and tip into your own trading method or your own analysis. So first I will start with actually Fibonacci, and I will teach you how to put levels, because I know that a lot of people use this Fibonacci tool that is default on all platforms. But to be honest, I use it as same as Chris. I use it a little bit different. And the first thing that we notice is actually, if you see, we use these ratios, but also it shows levels here. Okay, so this is a good tip for all of you who want to have this exactly the same. So you see here, by default, Fibonacci is not looking that good. It's basically like you were drawing some thick thin lines, and it doesn't show 78.6, it doesn't show 88.6. I'm not sure why. I personally, you know that I personally think that 88.6 and 78.6 are actually maybe even more important for forex trading than it's 61.8, because those are deeper retracements. And usually, guys, even if you simply watch the reaction at 88.6, you will see that there is usually a good reaction. It usually has at least some sort of reaction at those two deeper retracement levels. So usually you will not see this, but I will show you how to do that. And the thing is, you can also draw these dotted lines by yourself. So it's very easy job. So first go to objects list and then click Fibo and then edit. Okay. When you do that, guys, here you will see these are levels 0, 0, 2, 3, 6, 0, 2, 3, 8, 2, and so on. So if you want to have the levels described on your Fibonacci tool, because it's much easier, right, to see the exact price levels, then you just need to actually enter percent and dollar. But if you do it like this, for example, just percent and dollar without a space, okay, you see it will be it won't be showing correctly. It will be glued to actual price level. So what you want to do actually, I usually do it. I press 3 times space button. So this is 38.2. You see percent and dollar and 1, 1, 2, 3. So 3 presses on the space button will give you levels like this. Oh well, now this is actually much better. So you can see there is an empty space in between these levels and Fibonacci ratios. So do it. Okay, I think that you can easily make it as I'm showing. And also when you go to objects list here, you can change the color. So this is the style. This is actually your own preference, whether you like thick, thin line. Well, this is something in between thick and thin, but let's call it thin line. Then these dotted lines, I like this, so I will keep it like this. So once you have it, the time is to actually use this little tip and trick. So this is naked chart, so you see there is no indicators except for my favorite MACD. Of course, there is 99% of chance that you don't have this indicator. And as always, guys, you're all our friends, our traders, colleagues, and I'm very eager to share this indicator also with you. So just send an email and this will be shared, of course. This is a 3-color MACD indicator. It's useful for these kind of mini systems, okay? And this is what you can also apply to your own trading. Also, this indicator, this is simple swing point indicator. So maybe you don't have this indicator too, but anyway, you can have it for free, of course. Send us an email, you will be given. So how you actually do it? So you need to, I don't need this indicator personally, but because there are always new people watching us and these webinars are uploaded on YouTube, of course, this is easier for new traders to find exact swing points, and this indicator captures swing points correctly. So this is actually, so when you see this is upswing, this is downswing. So you actually want to take trades on Fibonacci swings and with confirmation of this indicator. So always is the best option always to find the deeper retracements. So once I plot Fib levels here, I want the price to, I don't want to take 23.6. This is a no-no for me, but here we have a runaway gap, so it doesn't matter. The rules are very simple, guys. So swing high, swing low, from left to right, always from left to right, from past to present, to give you the future outcome. Okay, so one of the reasons we actually draw fibs from left to right is to give a significant punch to the past, significant punch to the present, and that will be maybe a possible outcome in the future. So this is past, this is present, the future outcome is, right, profits. Okay, so very easy logic. 1 + 1 = 2, 1 + 2 = 3, 2 + 3 = 5. Past plus present equals the future. Don't forget, Fibonacci ratios have a very common, they're very common in nature, they're very common in universe. Okay, don't forget it. Milky Way, our galaxy, is 61.8. So everything is connected, even here with trading. So because of the reason, I don't really like to watch these simple retracements like 23.6. This only happens, guys, when there is a strong trend. Okay, this is a runaway gap. Okay, breakaway, runaway gap, and you see there was no gap close, and the thing is, the price just proceeded to run from the gap. So not just coincidence that we can see 23.6. Usually, if you try to trade daily markets with 23.6, I mean intraday trades, you will be stopped out, because simply that it's not enough retracement. Okay, here really 33 points of retracement after 135 pips drop. Well, it's too low, right? So because of that, I really love to use at least I like to see 50, 61.8 and upper levels. So that is what I prefer, and when I see, I trade. So for this occasion, we will use next swing. So this is a swing high, this is swing low, or we can use this one. Okay, why not? So this is swing high, this is swing low. Let's see. Yeah, 50 retracement. Now, how we actually can trade with MACD and Fibonacci? Well, guys, very simple. Here, you see, there was a Fibonacci touch of this level, but the thing is, see MACD. MACD was simply at the same point. It didn't move. It didn't make a new low. So what you want to see is the price, the MACD should be red. Very important. It should be red. And MACD should show a new low for this. So for next example, I think it will show you the entry. So swing high, swing low here. Okay, swing high, swing low here. Watch this. And where did MACD signal your entry? Exactly, guys, at this spot. Okay, you might say this is maybe a little bit late entry, but actually is not, because once you see, but you need to watch this in real time, that MACD is actually breaking through this low here, you open your entry. So this could have happened probably a little bit earlier, here or there, because you need to watch MACD real time. So retracement is good. So this is your first signal, retracement, at least to 50. So here you had retracement to 78, 88.6. And here there was actually a new low from MACD telling you that the signal is actually good. So this is your confirmation. You see, it's red, and it needs to be a little bit below this one. So usually it will be in real time, so you just need to watch it, and it will be a good signal. Now for targets, guys, we use Fibonacci expansion. Okay, so this is simple Fibonacci trading. Fibonacci expansion, how you do it. That is why I put swing points for you. Because when you have swing points, you actually know where to put retracements, right? And maybe if you're still struggling with finding good swing points, well, this is the indicator for you. So just tell me, Nana, Chris, we want this indicator, and guys, you will have it. So here, so how you draw actually this retracement? This is the correct way to do. From the top to the bottom, but you need to actually place it on the exact swing, not on the signal. So this is the exact swing here. So your signal probably would be to go short around 3.2. And if the first target is too low, you never take profits here. You actually try to take profits on Fibonacci expansion 100 or 61.8. Okay, so here you see the price is dropping. Here was your entry somewhere. Okay, here, so I guess here there was something like here there was a signal for an entry. Stop loss is 5 pips above last swing high, and your targets are 161.8. So what can happen is like this: when price actually goes through this target but does not hit 61.8 only later, there are a couple of ways to manage the trade. First thing is you actually take profit here and you don't wait for second level to be hit. So it's kind of like 30 pips of profit. Next thing is you can actually take half of your profits. It's called scaling out. That half you should leave it running freely, and the other half should be put to break even. So if you made your entry here, you put the second half of your trade at break even, letting the first half make you free profits. It's called a free ride. And here, actually, when price breaks this 100 by 5 to 10 pips, you move the second half of your trade that is running freely here, and you're actually making a profit stop. Another way is actually to not to take profit, not to scale out, but rather to move your stop loss here once the price breaks Fibonacci extension by 5 or 10 pips. So you just make it 2 or 3 pips above this resistance, not at the exact resistance, but 2 or 3 pips above. Because if there is a retest, not very often, but sometimes you will see a retest continuation without hitting you. So not at the exact level, but just 2 or 3 pips shy from this Fibonacci expansion. Guys, same goes for uptrend, and it doesn't matter. You can do this even for 115-minute time frame. Okay, why not, guys? Another tip is you can easily spot a trend by actually using trend lines. So 15-minute. Remember, guys, every time frame has its own trend. Okay, even 1 minute can have a trend. Why? Because trend is simply a series of higher highs, so for uptrend it's higher highs and higher lows. For downtrend it's lower highs and lower lows. Simple as that. And that can exist on each time frame. 1 minute, 5 minutes, 15, whatever. Just the pip count is not that big. Okay, so you need to be prepared for not so many pips, right? So here, guys, this is an example. So see, we have an uptrend here. So here we have swing low, swing high. So where do we make an entry? Insert, Fibonacci, retracement. This definitely qualified for an entry. See here. And watch this, guys. Even next candle here was a bit shorter. So for uptrend, you need to see MACD not going lower, but higher. And here you see MACD went higher. And here there was actually a signal for you somewhere here to actually go long, and you went long. So as you can see, you can find a lot of potential trades here. You can scout with this tip, a mini system I call it here. Swing high, swing low. Now, if you see this scenario, what should happen is that price actually this is actually your signal. I think that this candle, and yeah, this probably would have been the signal because this candle closed like this. But here at this point, probably it showed a bit, it was a bit higher than previous candle, than previous histogram. So this could have been your entry. But the thing is, you see, the price turns violently. Today, it's not good day to show examples because Brexit, there is a lot at stake, so price goes simply up and down. It's better to go to history and try to find actually better examples. But you see, the logic is the logic. So once you spot a trend, and the trend is spotted by series of highs and lows and trend line, here is, you see, you can incorporate this tip and trick into your own system, guys. Okay, here you see this was where the arrow showed, and actually this is the swing here, and you see next one happened here, And here, this was your entry. As soon as this candle started to go up, this was your entry. And again, Fibonacci extension or expansion, how people call it. Again, very simple. From this part to this part to the exact swing. Everything is shown with these arrows. You see first target hit, second target hit. Okay, so that's it. Why not? You can try to trade this. Okay, maybe incorporate it into your own trading method or your own trading system. As you can see, it's a bit simple. You don't have anything to worry about. Every single pair can be analyzed or traded this way. So actually, you see, it's bit easy, right? Don't forget this. Okay, so Fibonacci here. You see how I made this. So also, if you don't see 78.6, you just need to add manually here. Type 0.786, then type it here, percent dollar, 78.6. Same goes for 88.6, okay? You will find a lot of good trading opportunities. Let's see, guys, Euro Wadi, I told you that it should go down today, and I hope that you shorted it, okay? Even on 15-minute time frame, it looked bearish here, guys. Even on this time frame, it looked bearish, and I hope that you made some profit. I tweeted, I'm still in a trade, and it's like almost 100 pips from the entry, and I think this was the trade of the week on Brexit day. Very, very good behavior from Eurodollar. If you don't know what I'm talking about, just check Admiral Markets technical analysis for today. For this example, well, guys, very easy. Watch this. Okay, so here you have a downtrend. Even this candle here, you see a series of lows. So let's use this last example. Okay, so Fibonacci retracement from the top to the bottom here. Okay, so you could start looking for entries at this candle here, 50, so this is it. Okay, see, but you need to have a lower histogram to actually confirm an entry. So here, this is a confirmation here. See, the price went to 78.6. No, this was the confirmation. See how this histogram was lower. So for this candle, for stop loss is very well, like 30 pip stop loss because 25 was difference. 30 pip stop loss for Fibonacci expansion. Same applies here to here and there. First target, okay, hit. Second target hit. Okay, so you will find this probably interesting. Why not incorporate it into your own methods? We are always coming in with something new, something useful, and I'm sure that you will always see something useful. Actually, this is also part of our price action training school, but we will cover this in the section when we go with finding confluence points and so on. So guys, I hope that you enjoyed this presentation. For all questions and comments, we are always open. If you need indicators, if you need us to send this swing point indicator and MACD 3-colored, well, of course, just send us an email. You can send an email to tarantulafx@gmail.com. Okay, and of course, you will have this for free. So let's see if there is any question that I didn't see. Ronald Bergers, you're so cool. Thank you. Thank you. Ronald, again, how would you define the target? Sorry, Ronald, I just saw your question. And yeah, you see the targets. Very simple. Idris, how you create Fibonacci extension? Simple. Insert Fibonacci extension. See, there is this is by default on MetaTrader 4, so very easy. This webinar is being recorded. Chris is recording the webinar, so it will be uploaded, so no problem. Next question, Ron. Thank you, Ron, for your comment on Twitter for the timetable. Very useful. I will be actually covering today via Twitter. You will be reading it. This webinar will be uploaded probably tomorrow, John. I think it will be uploaded tomorrow. So stay tuned. Maybe tonight, but better to wait for tomorrow. And here you see the address. YouTube here. So see, well, Fibonacci versus use, we won't be using this for actually Brexit or Remain. We will see. Next. Okay. Do we see other question? Okay. Let's see. Comment. Late entry to webinar. Mask rider. Well, Mask, no worries. This is recorded and it will be uploaded. How do you use MACD, John? Here, John, you see, you just need to watch for swings, and valid swings are from 50 to 88.6 retracements. So here, for example, you see we had a first swing here. I will zoom in. So here there was a first swing corresponding to 50% of retracement. But in order to actually take a trade, you see, because this is downtrend, you need to watch this histogram, current histogram, lower than previous histogram, real time. So the only histogram that was lower than the previous histogram after 50 and 78 was hit is this one. So you see, 78 was hit. So this is the first qualifier for an entry here. But at this point, you see how histogram was looking like this. Here, histograms start to be red. And as soon as it starts to be red, it means that it's lower from previous one. You take the trade. You see? Very simple rules. And here, see, this histogram started to be red. Bang, you're in. I think that this is very easy, really. Same goes for uptrend. Same here, you see, swing low, swing high, uptrend, trend line. See, this is 78.6 retracement. So this was the qualifier here. And actually this here, next histogram was lower because it goes up here. You see, it doesn't go down. Because if it went down, the price would go here. But because this price is going up, also this histogram confirming that actually MACD confirms the entry here. See, this histogram is higher than previous one, and it goes up. So very, very easy to use. There is no hassle with this. Let's see if we can find another example. Let's see here, just for an entry. 50% retracement, first qualifier. So here it was, and you see this histogram confirmed up movement. Well, you need to have this MACD tree color, like it's easier, so please, well, just send an email and everything will be for you, for free, of course. Thanks, guys. We will be covering MA, so please, questions. If you want to know everything about AM, Brexit, and whatever happens, we will be covering. So use this hashtag AM Brexit FAQ, and questions will be answered, and we will see what will happen. Thank you for listening. We will be here with you very shortly, very soon, and be careful. Stay and trade safe. Cheers, everyone.